The last person talking today is Adrian Day. He's the founder and heads up Adrian Day Asset Management. So I've asked him to talk at the end of the day because I want to get a look at where the gold market is, where the gold equities are, and reflect on everything we've heard today and get an idea of where we think things are going over the next 12 months. So Adrian, thanks so much for coming down and ready to hear you talk.
Well, thank you very much, ladies and gentlemen, for that welcome, and thank you for inviting me. So I'm going to talk today on gold mining stocks. The title is, Has Anything Changed? I'm going to tell you everything that's, not everything, I'm going to tell you some of the things that's wrong with gold mining, the gold mining business and the gold mining stocks, but I'm going to end on an optimistic, or I should say positive, on a positive note, and really quite a positive note. But, you know, we often wonder, we often complain, those of us in the sector say, you know, it's a very small group of people that are interested in gold mining stocks, and why can't we get more people interested, and so on. Well, this is a graph that shows you how gold stocks have underperformed gold. This is for the last 5 years. So if you look at that and you look at this graph, Yep, there we go. Look at this one, which shows you the major mining companies around the world. Only 2 have actually outperformed gold in the last 7 years. One of them extremely marginally. Only 2 have outperformed gold. Yet we always tell people the reason you buy gold stocks is because of the great leverage you get to the gold price. And then we could go further back. I guess I have to click it twice. There it goes. This is from 1997. If you had bought the XAU index of leading gold and silver companies in 1987, you would be losing money today, more than 20 years later. So is this a good investment? Or let me put it another way. Is it any wonder that most investors are not particularly interested in this sector? Now, let me break down some of the problems. There are inherent problems in mining. Mining is a very difficult business inherently. But I have to say, I think a lot of the problems are exacerbated by poor management decisions at many companies. So let's look at some of the problems, and we're talking here primarily about the major companies. We'll talk about the juniors a little bit later. But you've got reserve depletion coupled with very few discoveries. Remember, a mine is a depleting asset. When you mine an ounce of gold, if the mining company is going to stay where it is, not grow, just stay where it is, it has to replace that ounce. If it mines 5 million ounces a year, it has to replace 5 million ounces. Oh, sorry. There we go. So this is the, you know, anyone producing 1 million to 5 million or more, you've got to replace those ounces every single year. Now, the plain fact, most of you will know this, but it's important to realize, the plain fact is that we are not finding the number of ounces that we are, as an industry, producing. We're not finding the ounces. So Newmont cannot continue to mine 5 million ounces a year for a long time. If Yamana continues to produce 1.2, if Goldcorp continues to produce 3.5, etc., they cannot all keep producing what they are producing now because we are not finding those ounces. Now, not only are we not finding the ounces, but as you can see here, the number of ounces, the number of discoveries has gone down. I was going to say fairly significant, that's British understatement, has gone down very significantly over the last 20 years. So at the same time, you're seeing a much longer time frame from discovery to production. Now, I should point out this is not gold, this is all minerals. Gold mines tend to have a shorter time from, I think it's true to say, a typical gold mine will have a shorter time frame from discovery to production than, say, a copper mine. A lot of copper mines have been discovered 30, 40, 50 years ago before they're put into production. But nonetheless, for gold, as well as for other minerals, it is a long time from discovery to production, and an increasingly long time. Why an increasingly long time? Well, several reasons. One is that we found all the easy stuff in easy countries, so it's getting more and more difficult to find good mines. You have to go to bad, I'll call them bad jurisdictions, or you have to go to more marginal mines. But we found the easy stuff, by and large. And then also, of course, you have governments getting in the way, and NGOs getting in the way with all sorts of, permitting processes are much, much longer now than they used to be, and so forth and so on. So it just takes longer to get a mine into production. There we go. And this graph, I'm sure many of you have seen this before. Some of the major mining companies have used it. But if you look at the graph on the left, your left, which I showed earlier, which is the discoveries, and then you look at the graph on the right, which shows you the production, you see a pretty close correlation between discoveries and production 20 years later. And if that is going to hold, you can see that we have declining global production of gold for the next several years. Now, this is a good thing, by the way, if you have gold, or if you make a discovery of gold. To exacerbate it, or to make things even worse, the grade is declining at mines. And this shows you that the average grade of producing mines, mines in production, is 33% higher than the average grade of mines in development. We're not talking about exploration projects, we're talking about mines in development, deposits in development versus producing mines, 33% higher. Now, there's different reasons for that, but one reason I alluded to earlier, which is that, we found the easy stuff and we're getting more and more marginal mines, but we're having to develop, that big companies are having to develop just to stay where they are. And frankly, the other reason is we've had high grading. When prices are low, a lot of companies start high grading, which is an artificial way of keeping their revenue, I won't say earnings, because most of them don't have earnings, but keeping their revenue and cash flow fairly static so that investors are happy, but it's just stealing from the future. Partly because of the grade depletion, but also for a lot of other reasons that I'll touch on in a second. Costs have gone up. This is really quite staggering. You look at the prices of three major mines, the three largest North American mines in 2005, 2006, and look at what they were in 2013, and you see just an enormous, enormous jump. Let me say a word on cost, by the way. I don't think there's a single company in the world that says our costs are $1,883 an ounce. But that's because most companies don't report what I think of as real, genuine, all-in, and I'm not talking about all-in sustaining costs, all-in costs of running and operating a mining business. Again, remember, there's two factors here. Remember that a mine is a depleting asset. If the company's going to stay where it is, it has to go out and find or buy more ounces to sustain itself. Finding or buying ounces is an expensive proposition. So if you exclude the ongoing costs of running an ongoing operating business, well, of course you can report lower costs. That's number one. The other factor that is not in any way fraudulent, don't get me wrong, but you have to be alert to it, is when companies report gold equivalent ounces. And I won't go, I mean, we can talk about it later if you want over a beer, but I mean, it's a perfectly genuine way of reporting your costs, but you have to be aware of it. If a company has 30% of their revenue from copper and they report their gold equivalent with the profit they make from the copper as a reduction in their cost, you're getting an artificial cost for the company, an artificial cost of mining. You're getting a marginal cost of producing an ounce of gold with the profit from your copper deducted from it. But that's not the real all-in company operating cost. So suffice to say, the costs have gone up, and they've gone up meaningfully, and also most companies are not reporting what it is costing them to remain a sustainable, ongoing business, which includes exploration and acquiring new projects. Now, since 2013, prices have come down a little, but the most important thing to look at on this graph is that the price of gold declined much more than the price of the costs of production. And costs are still high, so we'll skip over that. I think I've made that point. Now, costs of mining are high despite the fact that the mining companies have had dramatic help from the price of oil. Energy costs are the number one cost input for running a mine. Price of oil has declined dramatically, so that should help the mining companies on the cost front. The second thing that should help them, or should have helped them, is the period up until, if the dollar's strong, other currencies are weak by its nature. So the Canadian dollar, the Brazilian real, the South African rand, the Australian dollar, all of the countries where, the Chilean dollar, all of the peso, all of the countries where you operate a mine, their currencies are lower, which means their costs are lower. So after energy, the second largest cost input of most mining companies are local costs. Local costs include your mine workforce, the local mine workforce. But it also includes everything you do down there, the camp you build and everything else, which are all local costs. So if the dollar's strong, that should help your costs. So what is this? Yes. So gold, since 2009, is up 20%. That should be good. FX and oil are down, but the dollar and oil are down. That should be good. And yet the mining companies are not producing any profits. These are the profits of mining companies going back to 2005. And you can see that they've made losses as often as they've made gains. And then, of course, when you look at mining, there are other things we have to look at, some of which are partly or largely out of control of the mining companies, admittedly. Anti-mining protests, I referred to that earlier, the NGOs and all that. Come on. Well, who is this guy? Oh, yeah, dictators stealing mines. We've seen that, obviously in Venezuela. We also saw it in Tanzania, which 3 years ago, was considered a darling on the African continent. Well, they just presented a tax bill to Acacia, which amounts to about 100 years of its operating profit, saying they owe it in back taxes. Don't know how they calculated it, but anyway, taxes up. The problem with mines, of course, are that they are fixed assets. When you find a mine, first of all, you can't always choose where you find it, but having found it, having spent millions and millions of dollars exploring, having spent billions of dollars developing the mine, the one thing you can't do is pick it up and move it somewhere else. It's not like a factory producing widgets. So, governments do frequently see a golden goose and they pluck it. Is that what you do with geese? I guess. But anyway, so it's not infrequent, but once a mine's up and operating and the capital has been spent, it's not unusual to find the government start asking for more money. I mentioned Tanzania as one example. Indonesia is another example. Freeport has an enforceable contract with the Indonesian government, but the Indonesian government says, we're not going to operate under contracts anymore, we're going to operate under another system, and you owe us this, and you owe us that, and you owe us the other. And mining companies have the option of trying to negotiate, which is what Freeport's doing, or basically taking them to international arbitration. Take a government to international arbitration, the first thing that normally happens is your mine gets closed pending the time frame of the arbitration. So it's not an altogether attractive alternative for a mining company. And we can talk about Freeport if you like in a second. So what else have we got? So again, it's not surprising the mining companies have losses. But a lot of what I've said so far is sort of inherent in the mining business, but mining companies have really, in my view, made matters far, far worse. Most mining companies, and this is most gold mining companies, I should say, because I think some of the base metal miners are a little bit better, but not much. But I'm talking about gold anyway. Most gold mining companies are pro-cyclical. Pro sounds good, but in fact in this case is bad. Pro-cyclical basically means when the price of it goes up, well, you decide to go out and overpay for marginal assets, as you did in 2010, 2011. But when the price comes down and companies are bankrupt and going out of business, you decide not to buy anything. So that's exactly the opposite of what you should do in a cyclical business. Mining is a cyclical business. There is no way around that. You cannot escape from it. It is a mining business. Therefore, you have to invest against the cycles. When things are high, you back off. When things are low, you invest. Some companies did that. Agnico Eagle did it. Franco-Nevada did it. But frankly, there be exceptions. Very, very, very few companies were holding on to their cash in 2010-11 and were investing in 2014-15. Very few. When you consider the relative size of the nickel, steel, and gold markets, it is barely short of a crime, the difference in the write-offs in the different industries. Remember, gold is far, far smaller industry than nickel and steel and coal. And coal, for goodness sake, nobody likes coal. You'd think coal would have more write-offs than everything else. So what do we got here? Yes, these are write-offs by company. You can see virtually every company has that write-off. Every major company has had write-offs. The only one that hasn't is Randgold. Interestingly enough, wouldn't you know it, Randgold pays its chief executive one of the lowest salaries, and Randgold stock has been one of the best performers in the last 10 years. And it's not a coincidence. But this to me is the most shocking. Most of what the companies have purchased since 2010 has already been written off. We're not saying it hasn't yet made a profit. I could understand that. It takes time to put mines into production, and you have to put a lot of capital in before you get the money out. But most of it has already been written off. And most of the stuff, I would warrant to say, that Newmont, Barrick, and some others bought in 2010-11 should never have been bought at any price, let alone the price they paid for it. Now, again, they bought a lot, well, sorry, let's go back because I don't want to, a lot of assets that were bought or overpaid for in 2010, 11, 12 were not paid for out of cash flow, of course. They were paid for with debt. And so in the years from 2010 to 2016, we see debt of the major mining companies up nearly tenfold to a record. And this is the result. We've taken on debt and we've written off the assets that we acquired. Some of these mines will never come into production. So those are the seniors. So what about the juniors? Well, again, exploration companies have, I'm talking exploration, not juniors. Exploration companies have their own set of problems. Again, some of them inherent, some of, I'm looking for a signal on time. No, not yet, okay. Some of them inherent, some of them are of their own making. The biggest problem with exploration, of course, is it is difficult to find a good-sized mine. Newmont, this is Newmont's number. Newmont estimates that to find a mine of 5,000 ounces is 1 in 10,000 anomalies becomes a mine of 5 million ounces. It's a little bit of a cheating statistic because, of course, you can look for an anomaly and not think it's ever going to become a mine. You investigate an anomaly, it doesn't work out, you move on to the next one. But nonetheless, the point is it's very, very difficult to find a mine like looking for a needle in a haystack. So that's an inherent difficulty with a mining company, or with exploration companies. The second inherent difficulty with exploration companies is that they don't, by their nature, they don't generate cash flow. That means that in order to spend money, they have to raise money. And that raises a whole set of problems that we'll come to here. But how much do you raise, when do you raise it, and how do you spend it are the critical things that distinguish the good exploration companies, in my view, from the bad exploration companies. This chart shows you 75% of exploration companies spend more than 50% of their total budget on G&A. And when they run out of money, think about that for a second, because when they run out of money, they go and issue more shares, but the money they raise basically is just to support the head office, right? And then they do it again. So a lot of companies are spending 70, 80% of their total budget on head office, which doesn't make sense. If you think back to the difficult times, 2013, 14, 15, look at how many junior companies, exploration companies, cut the salary of the chief executive officer. I can't actually think of one. I'm sure there was one somewhere, but I can't think of one. They don't cut the salary of the chief. Well, they should, shouldn't they? When things are going badly. It's not their fault that the market's down, but it's not our fault as investors either. They make sure they get paid. The result is, now this is just I mean it truly, this is an arbitrary list. And if this list probably distorts it favorably, because these are actually stocks that I own. And I am very, very, very alert to excessive dilution of companies. So this really is a distortion in favor of a conservative distortion. But look at it. This is in 12 months. We're looking at 12 months. Look at the bottom one. The share count has more than doubled. That means that the company has to be worth more than twice what it is today. It has to be worth more than twice what it was a year ago. Be worth more than twice in order for the share price to be the same. And it just doesn't happen. So I asked the question, how did that work for you? Well, not too well. How about you? Not too well. Remember, these are companies I own. They're the good ones. How did this one work? Not so good. Now, don't misunderstand me. Companies can, again, I said it, when you raise money, it depends the use you put to it. Now, I'll mention a particular company. I'm not recommending it, but just as an example. This is a Cisco Mining. Look at the extreme jump in the share count that they've had. And it hasn't just been one jump, it's been an ongoing jump continually for the last several years, okay? But they put the money in the ground. They drilled with it. And so the result is a share price that has gone up over the same period. So even as the share count went up by a multiple, I mean, I don't even know what the multiple is from beginning to end, but it went up by a large multiple. The share price has also gone up because they've been putting the money in the ground. And that is, and they've had some success. I mean, they've been lucky as well. But, 5 minutes. So let me just cut out with one last graph, because, sorry, that's for Monty Python fans. We don't need to worry about that. This is the key, where's it coming? This is the key slide. No, gold stocks are undervalued. But here's the key one. Gold stocks are undervalued relative to book value. Gold stocks are undervalued relative to cash flow. And here is the key slide. This is the fourth major buying opportunity of the last 30 years, in my view. This is a graph of the XEU, and you can see that every decline of more than 50% has been followed by an increase of at least 100%, and 100% is the minimum. That was in 1992-94, when gold wasn't particularly doing much. But if you look back to 85, 86, 87, 150%, or in the early part of this decade, over 300%. I think we are poised for another major rally of at least 100% in the senior index. And if the senior index can go up at least 100%, you know that if you pick and choose your stocks well, you will be able to do much, much more than 100% in the next, all these 100% moves are in 12 months, by the way. So you can get, I think we are poised for another major turn in the gold mining sector. So do I have time for a question? Yeah. Okay. See, any questions? I'm going to see if there's a good, sorry. Any questions? No? You're all ready for a drink, are you?
How did you calculate the acquisition cost into your cost per ounce?
Well, okay, so a mining, I didn't do it, all right? So a mining company, basically, the theory, to be a sustained business, you have to include everything. You amortize it over the course of what you think the mine life will be. So if you have a 15-year mine life, you just amortize your capital over the 15 years. It wasn't capitalized, it was amortized.
And divided
by the mine life. Mine life. Remember in the old days, some of you will remember, in the old days in South Africa, there was a completely different business model. You had mining houses, and they controlled individual mines. And the individual mines that were publicly traded, the stocks that were publicly traded would own simply one mine. And everybody knew it was a depleting asset. So you owned a mine, it paid the dividends out to shareholders, so it paid whatever was in excess of the necessary capital, it paid out to shareholders, but there was no pretense that Driefontein, for example, or Durban Deep, was going to exist as a company beyond the life of its own mine. And that was the model. Now, the difference, of course, with the South African mines is they were 100-year mines. So they lasted a pretty long time. But then we had the North American model, which was to have ongoing operating, ongoing businesses. And I'm not really sure which is a better model, to be honest, because it doesn't seem to have worked too well for us. Yes, sir?
Any lessons from past bull markets?
Any lessons from past bull markets? That's a really good question. Yeah, lots, and it would take a long time. Obviously, one thing that we all know is you just mustn't forget to sell. I think we get wrapped up when the market's doing well. We all think we're geniuses, and we forget to sell. I personally don't believe in an automatic sell model. I know some people do, and there's nothing wrong with it. Some people will say, well, I use a 20% or 25% trailing stop on everything I own. Other people, and I don't think that's good for gold stocks, because gold stocks are so volatile anyway. But I can give you hundreds of examples. Think of Virginia that went from 50 cents to 35 cents. Well, with any kind of reasonable stop, you'd be sold out. And later, you missed out on a 10,000% return. Franco-Nevada did its, its IPO of 15, it dropped to 10. That sounds like a pretty reasonable place to get out if you're using a stop. So I don't like stops, but it's a rational discipline. Other people have a discipline where they sell half if it doubles. I don't really believe that. I would rather sell the ones that are overpriced or aren't doing so well and buy more of the ones that are good companies that are doing better. But of course, that's less objective and more subjective. Wow. Okay. Well, that's a huge question, and if I may add another question to it, what effect would it have on gold?
Exactly.
Yeah. Because let me answer the last one first. Well, first of all, yes, I think we're going to see tightening, but tightening very much in quotes. The Fed, to me, has demonstrated that it is extremely cautious in any kind of interest rate move upwards. And I think the problem is that the longer you remain cautious, the more difficult it is to act less cautiously. I mean, it's the same of anything. You know, if you're disciplining children, I mean, if you let them get away with it once, twice, 3 times, 4 times, you keep putting it off, it's much more difficult to do later. But the Fed has been extremely cautious, and, you know, they seem to always be looking for or catching an excuse not to raise. You know, Brexit was an excuse not to raise, and Ukraine was an excuse not to raise, and I can't even remember all of the, you know, there's always something happening, and it's an excuse not to raise. So I think the Fed is, I think we're definitely we've started a tightening phase, but I think the Fed is going to be extremely cautious. And by the Fed's own words, when you're looking at reducing the balance sheet, remember the Fed's balance sheet in 2007 was considerably under $1 trillion. It went as high as, I think it was 4.5, was it? And they're talking about reducing it by 2021 to 3.5. Well, 3.5 is still almost 4 times what the size that it was in 2007. And it wasn't exactly small in 2007. So again, even their objectives are cautious. But I think you hit on a really key thing. A lot of analysts and observers have said, you know, one of the problems with rates so low, with negative interest rates or 0 interest rates, is you don't have any firepower for if we have another recession. And so I think part of the thinking, I may be wrong here, but I wouldn't be surprised if part of the thinking of the Fed is, well, let's at least raise rates a little bit so we have some firepower if we do have another recession. But what it would have on gold, I can talk a little more confidently on that, since this is Fed rates going up. And I just want to show you from history, this is 1976 to 1980. Now, most of you don't remember this, but I remember it. Those who remember it or have read the books know that interest rates started to move up well before Volcker came in, and gold continued to move up throughout the whole period. So the point of this graph is that interest rates moving up do not need to be negative for gold, particularly if the Fed is not ahead of the inflation curve. It was only when Paul Volcker came in and moved rates up well ahead of inflation with the objective of crushing inflation that it destroyed the gold market. And here's a more recent example from 2004 to 2006, where in those 2 years we had not just higher interest rates, we had a continual step up in the Fed funds rate, right? It continually stepped up, and yet gold flat for a while, and then gold moved up. So the point I'm making is that high interest rates, unless they're dramatically higher and significantly higher than inflation, that is, unless real rates are moving up in a fairly dramatic way, it doesn't have to be negative for gold at all. Is that it? Thank you.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?